good morning to everybody and welcome to this latest in our EPRA research webinar series. I'm delighted today that I'm joined by two people who are experts in this particular field, Dirk and Martijn. And today they're going to be talking about a paper which we commissioned for EPRA that they've authored called Disentangling Social Impact Ambitions. So I'm going to hand over to them in 1 second. For people who have questions, please put questions into the Q&A or indeed into the chat. I'll take those questions towards the end. Martijn and Dirk will present. I'll ask a few questions. We can take questions from you, and we should be gone through this in about 30 minutes or so. So, Dirk and Martijn, over to you.
Thank you very much, Alex. Good morning, everyone. Thank you for taking the time. So my name is Dirk Brounen and Martijn Stroom is my colleague at Maastricht University. And in 2024, we were invited by EPRA to do this survey research on a topic that is quite intriguing. So I will start my presentation with a small disclaimer. Because, well, it also has to do with ESG. And we were also told, and we also noticed that the world is moving around a bit and shifting. So some people might think, well, ESG, maybe that is less relevant, or I have my own personal view on that. That is fine. So we are realizing the fact that the world is becoming a bit more volatile. Let's quote it like that. So you have this spectrum. People at the far left who are very pro and like to do a lot more than we do currently. And there are also people more on the other end of the spectrum, which are maybe delaying some of the initial ambitions for some reasons. And this is not us telling you what to do or what we think of this. We are really genuinely welcoming everybody from all sides of this spectrum, and especially everyone in between, which I guess everybody will be, right? So this will not be a preach or will not be a pitch on how you could become more ESG compliant or whether you should do more. We were really curious what people think. That's also why we did this survey research. We really ask open questions to people, and we are very grateful for everyone who has participated and shared their anonymous opinions. And today we're going to give you a preview of this. I will also show you at the end of this talk that there is a QR code which gives you still access to this survey. So it's still running. So if after today, or maybe you watch this clip later, you would still like to participate and give us your peace of mind on this topic, please do. So it's still up and running. So we are studying the S of ESG mostly. So it's the social impact aspirations. And maybe we have to define a bit of that. So in real estate, we really are looking at topics like affordability, which is, of course, under great pressure in many countries in the housing market, especially, but also tenant well-being can also be in commercial real estate. Also health-focused retrofits. So if you want to improve, let's say, your property beyond, let's say, the legal standards, because you know about indoor air quality or natural light, these kind of things are getting more in swing. You will also see that your tenants benefit from that, but it's also all part of social impact. And it's up to you as a landlord to do this or as an investor. And of course, this has a cost. And the benefits of this we call also social impact. And this is somewhat overshadowed. We will also show this in a few minutes when we look at ESG, because, well, the E of ESG has become a lot more dominant in the real estate market, and people also know more about it. So we have the carbon footprints in that area, but also the energy efficiency metrics. But for social, there's not a lot known. And that's also the reason why we did this survey now, because we really wanted to know what was in the fall of 2024, the status, and we can also compare this now in the spring of 2025. So the main struggle that we would like to know more about is the question that people might ask themselves if they're completely honest: should I be willing to give up financial return for social impact? So some people say, well, Dirk, that's actually not a good question because I don't even think you have to give up financial return for social impact. Well, that's also one view. Some people will say, we will give an example that it is by definition the case, because I will give you a question in which it's clear that you have to give up something in return for something else. But it's also whether you should be willing to do so. It's not should you, but should you be willing? Because you may also have to account for this kind of trade-off. And that is really what we want to know more about. And if you would be willing how much would you be willing to give up? And that is, I think, something that is underexplored, really, because if I talk to people in public after I give a talk somewhere, everybody says, yeah, I'm also really a great proponent of social impact. But then if people then have to start thinking about at which cost would that come into reality, it's a bit more difficult, and then it becomes very concrete. And what we do here in this survey is we're gonna interview more or less people in an anonymous fashion, so people can be very frank and open and give us their honest opinions. And we can only group them in 2 groups because we have targeted 2 different types of EPRA members or membership people who are more in a commercial role at a real estate investment fund. But we also have asked the same questions for people who were more a sustainability officer, who already are, let's say, related in their job to fostering this ESG policy. And we would like to see whether there is this gap between the 2 that you might expect or not. Plus, we will also find out whether there's anything different in patterns in their answers and in the trade-off when related to their demographics. So this is a first table. That's also why it's called table 1, I guess. And it has summary statistics. You don't have to look at everything here, but you can see that the survey on average has an age of respondents of 45. And the financial managers, the people in a more commercial role, are 60% of the current sample, and the sustainability managers are the remaining 40%, and the age gap between the 2 is very small. You can also see that the gender is quite split. 57% is male in our complete sample, and it's not that different across the 2 groups. What is interesting here, if you look at the second section of this table, the ESG priority, when we ask people to rank E, S, and G as such, you can see that in both groups, you see that there is this dominance of environment, the E part. And you could see that S is about 27% of importance of 100% in total. So really it is on the backflip, let's say, of ESG. There's also some talk about if you have to qualify your own ESG strategy, you can be philanthropic. So you say, I'm happy to give things away for free because I care about society, very altruistic. But you can also say, no, this for me is really a commercial trade-off. It really needs to recoup the investment, and then you become more responsible and anything in between. And this is where you can see the respondents have mapped themselves. So we have no philanthropic respondents, which is also not very common, I guess, in the real estate market. But do people say, well, for us, ESG is relevant, but it really needs to be more of an impact framework where we also include the financial consequences. Yeah. And at the bottom, you can see some topics that people quote as their top 3, which is quite similar across the 2 groups. So this is maybe my last slide, but it is my last slide actually, but it is maybe a highlight already. So Martijn will tell you a lot more and also a lot of interesting stuff. But one of the key questions we asked in the survey that you can still participate in is, let's imagine you are entering a new investment opportunity, and in this case, it's a residential fund investment. There's a portfolio of a standing investment with properties somewhere in Europe. And the only thing you need to know is that, well, you need for this investment to succeed 7% based on your risk profile here. So ex ante, you would like to make 7%. We did the calculus. Of course, we're scientists. You can trust us. There's no reason why we would lie and exaggerate here. So after careful calculations, we came up with an internal rate of return ex ante of 8.75%. It's an all equity return on investment on this residential fund investment opportunity. So happy days. So this is a very interesting opportunity. You can extend your exposure into the residential market. But then the question comes in, now let's assume that we propose this, and you can still enter in, but we add the idea of maybe fostering and increasing affordability within this portfolio. So instead of you taking the baseline proposal that we just discussed with 8.75% as expected return, you now reduce the rent level a bit to improve and enhance affordability of your tenants, which is of course a clear effect when you lower the rents. If that is the case, you are really gaining, let's say, social impact in your portfolio. And that's also something you can show and tell. The question here was, which return would be acceptable in order for you to do this? If you want to increase affordability, what is then the minimum return you would still like to require, assuming you also would like to reduce the rent level? And the answer we got back, and that's the average of the current paper, is 7.52%, which of course means this is 123 basis points less than the initial one. So the baseline model, 8.75%, people say, yes, I like that. I still like to invest in these resident funds. I'm also willing to lower the rent level and thereby improve affordability. But then I need still 7.52%, which is more than the 7% required return. It's not going back to 7% or even less, which would even might be remarkable. But it's also not that people say, yes, I'm willing to do this, but I still would like to have 8.5%. So this is the return, if you like, that people are willing to give up in return for a very concrete case of affordability and social impact. Yeah. So this is one of the key results at the moment, but now we have to disentangle it, because that's also what we promised in the title. And fortunately, we have Martijn Stroom in our midst, right? Because if somebody can disentangle stuff, we ask Martijn. So we'll ask whether there are patterns behind this overall aggregate average, and that's what will be the next part of this presentation. So Martijn, take it away.
Perfect. Thank you very much, Dirk. Yeah, so indeed, as Dirk said, what we're going to do now is we're going to focus around the same question, but we're going to really disentangle which specific groups show heterogeneity in their results. So I'm going to show you 3 examples which I thought were really interesting that I cherry-picked from the paper. There's more in the paper still to read, so please download the paper, read it. So what am I going to show you? I'm going to show you these graphs, and these graphs read as follows. So you see on the x-axis, you see the acceptable equity return. In the gray dotted line, you see the average that Dirk just talked about, and I'm going to show you for each group. So I'm going to split, and then we're going to see how that relates to these averages. So how do you read this? For instance, here in age, you see on the blue on the left side, everything above 40. So the median split is 40 in our sample for 40 years of age. Everything above 40 is accepting a lower equity return of 7.17, and everything below 40 or 40 or below is requiring more. So here you see the discrepancy between those two groups, a base point difference of 7 points. And that's already remarkable. So you see here that age, apparently the older group is requiring less, or is willing to accept a lower equity return for affordability than the younger group. You see the same with gender, although the differences here are a little bit less profound. So you see females are accepting a lower equity return, and the position in the firm that Dirk talked about earlier. So the financial experts, so the financial managers, are expecting a lower return than the sustainability managers, which on its own is already interesting, although the differences are not that big. Now, these are just the descriptives. We have 3 categories that we want to dive into a little bit deeper. The first of them being the time horizon. We asked them 2 questions, so I'm going to show you how we split the sample, and then I'm going to show you how that affects then the required of the acceptable return. So we asked 2 questions. We asked, how willing are you to forgo long-term financial gain? And you see here on average, the median is at 29%, from 0 being absolutely unwilling, 100 being completely willing. The median is at 29. Everything below 29, so from 0 to 29, we consider low willingness to forgo long-term, and everything above that, we consider high willingness. Of course, this is a little bit arbitrary. It's not 50-50, but because compared to the sample, we categorize them low and high. And we do the same for short-term. And you see here already that the short-term median is at 41, so there's less willingness to forgo short-term compared to long-term. That's already interesting. But what happens if we compare this with our main question? And there we see, actually not that surprising, of course, that people that are the sample participants that are willing to forgo their financial gains, have a high willingness, are also willing to accept a lower equity return for affordability investments. And you see this it's a bit larger for the long term. Once we consider short term, the differences is slightly smaller, but we see a relatively similar pattern. Yeah, interesting. Okay, we have another one which we think is also very interesting. And this is perceived materiality. So what do we think about here? We thought about, okay, you know, we have a difficulty really assessing what materiality is. Now we can ask a lot of questions, what's social, what's not social, but of course we have these ratings, rating assessments, certifications that are kind of in this domain. And we thought it was an interesting question to ask, where do you believe this materiality originates from? So do you think it originates from the firm, or do you think it originates from the certification? Another way of framing this is, do you think certifications are prescriptive, or do you think they're descriptive? So do you think they're describing what works, or do you think they are prescribing what you should do? And you see the average median there is at 28. So you see that the weight is that the firm is able to lead the pack in what is material in their operations. And indeed, the second part, which is maybe a little bit easier to understand, and actually is still very interesting, is, do you think these certifications align with your asset level impact? And those two are still slightly different. So you can still say on average certifications are very, very much leading, but when it comes to our specific operations, there's some disalignment. And you see there it's quite 50-50. So there's both, the half of the sample says there's a low alignment, or relatively low alignment, and half of it says there's a high alignment. How does this translate into our acceptable equity return? And this is very interesting. So Dirk already said in the beginning, the minimum required equity return is 7%. And here you see there are some groups that are diving below this. So all the sample participants that, or at least the category of sample participants that thinks that materiality really originates from materiality, originates from certifications, are willing to accept a really low equity return for implementation of these affordabilities. And the same goes for the alignment. So if you think that the alignment of materiality of a firm is high with certification, you're willing to accept a very low return. Which is very, very interesting, of course. So there's a lot of discussion to be had on what drives this. The last point which we want to discuss is what are the social preferences? And so these are the social preferences of your organization. This is the same framework that Dirk already mentioned in the beginning. To be very broadly, we categorize the median between responsible and impact, where responsible is that you consider market returns as primary, and you can have some social considerations, but it's not in a return target. And we have an impact category that does take social impact returns into consideration, and either it prioritizes it or it prioritizes finance, but we don't have anybody in the financial category. So we have that distinction, and we also have this ESG distinction in how much points do you allocate to social from the 3. And you see here nicely that the median in our group is 30. So this is what you would expect, right? 33 is like an equal division. People that are allocating less than 33%, we categorize as low social allocation, and everything above is high social allocation. And here we see something really different, really interesting. When we look at the comparison to the equity return, we see that the impact preferences, they indeed are willing to accept a relatively lower equity return compared to the median. But when we look at this weight of ESG, weight of social in ESG, we see that those participants that allocate relatively low points to social in the ESG framework, they're still willing to accept a lower equity return for implementation of affordability projects. So this is a really interesting key that might feel counterintuitive, but you know, we can have some nice, interesting insights from this of why this would be. just to conclude the results that we have here is that on average, the good news, if you will, is that there seems to be an anonymous willingness to forgo a baseline return to achieve social impact, if you consider this a key social impact strategy of affordability. But it matters who you're asking. So one, we saw the descriptives. So there's age, gender, position in the firm. Those have an impact on who and how much you're willing to forgo. But we also look at the time horizon, and there's more on the paper. So it matters what you're giving up, whether or not this is short-term or long-term, but also when these social impacts materialize, so whether that is short-term or long-term. Then there's also a high impact on those who have high trust in these certifications, whether or not you have a high trust in certification, or whether or not you have a high trust in the alignment of materiality between your own firm's actions and impacts of actions that will increase certification scores. And the final is indeed the final slide that I showed you before, is that those who are not openly are prioritizing social within this ESG framework might still be front running in what you could consider social impact. So this is really, really interesting to have as an underlying discussion point in should we prioritize ESG versus should we prioritize social impact. Those might not seem to be completely considered the same, which could be both good and bad news from a discussion point of view. As I said, there's more in our paper. We've talked about affordability. We've done exactly the same for retrofitting, which is another social impact goal. And there we even see, again, some preferences invert. Really interesting to see what these differences are between the understanding. One takeaway, before I don't want to lead the discussion here, but one takeaway is that there really seems to be heterogeneity on what the definition of social is, what the definition of impact is, and what then the definition of social impact should be. So that is really interesting moving forward to get that insight. And again, also the time horizon really seems to play a role. So what are we giving up? Is there an understanding of what we are giving up? And if this really, if there's alignment between everybody on board on what the impact should be short-term, long-term, and what you're giving up and how that balances out.
Perfect.
Yes.
So this is the one thing I promised at the very beginning. So there are two QR codes, and that might be confusing. So you can go left and right, like I said also at the beginning. In this case, it has consequences. When you go left, you can automatically enter, let's say, the report that Martijn was just referencing to. So there's more to say about what our results have to offer when you go just to the left. But if you say, well, that's nice, but I also would like to speak up and give them our peace of mind, that's fine. Then you go to the right side QR code that will enter you into the survey, which is still open. We will timestamp, you will still be anonymous, but after today, we know these people have had the opportunity to see the overall first batch of responses. So we can distinct this later on if people are concerned with this. But we are still interested in having, let's say, people participate, so please do. Then you go to the right. If you say, I would first like to have a look at this report that Martijn really was referencing to, please do. Yeah. So then maybe back to you, Alex.
Yeah, fantastic. Well, thank you very much indeed, chaps. That was really, really interesting. Just a quick question. I've got a few questions, and please, anybody who's got questions, put them in the chat or Q&A. Just a clarification. When you were talking about certification versus firm alignment, am I right in thinking that's the equivalent that we think of in terms of, are you just greenwashing and you want to show people you've got a badge to say you've done well, or you actually believe in those values intrinsically within the firm? Or is that a mischaracterization? Is that roughly the sort of way you were looking at it, or how would you describe it?
Yeah, that's a good question. So it's greenwashing to the extent that indeed you're meeting certification requirements and you're prioritizing that over your personally internal considerations of improving impact. Yes, whether or not it's strict greenwashing, of course, you could still say, well, I mean, you're diverting the responsibility of impact to the certification, right? That could might not be classic.
Greenwashing is probably a bad term, but you get my point that it's actually
yeah, of course.
External validation is probably a better description of it rather than core
100%.
internal values.
Yeah.
Yeah. So that's amazing. So out of interest, I presume you went into this with a few ideas about what people were likely to say and the different sort of groupings. What was the sort of the biggest surprise between what you thought was going to happen and actually the responses so far? And I'm aware that you might get further responses following this, but in terms of your sort of results so far, what was the biggest surprise for you?
Yeah. So that always happens, right? So we are scientists, so we are trained to be open-minded. That's like I said in the beginning, we didn't have our own, let's say, preference here. But you would expect, let's say, normally, I think, younger people to be more, let's say, prone to trade off some of the return for social impact. And the results actually show the reverse. And that is maybe also the definition of 40 and younger being young. Well, maybe some of my students disagree with that, I guess. So I do think if I talk and interact with my students, I do see they have this intrinsic drive that I don't really see with people of my own age category, which is, of course, 31. So, which maybe is not completely true.
Numbers, Dirk, but hey.
Yeah, no, I'm actually 48, so for the record, yeah. No, so I think that is a surprise, but also there, in also this first diagram that Martijn showed, I also would expect people who are taking the job of a sustainability manager to be more inclined. And that's also, I mean, the difference wasn't big, but it was reverse of what we would expect. But it can also be good because, well, people who are in a financial position are not by definition, let's say, skeptical, right? So it maybe also tells a bit of our own prejudices that we were surprised by that, but that's actually what came out there. Yeah.
That's really interesting. And out of interest, do you think there's any scope for people to effectively sort of slightly game the system? In other words, when you're saying that sustainability people might have given the responses they believe genuinely, but non-sustainability people might have actually thought, I need to give an answer that shows I'm not just a hard-nosed IRR-driven sort of private equity style person? Or do you think there's some of that? I mean, it's a hard question to answer. I completely understand, but it's...
Well, I mean, technically, we would hope it's anonymous, right? So that there shouldn't be really incentive to do this. And interestingly, I mean, this is also an interesting. Read the paper, of course. This is what we will advertise this a lot, but it's really interesting to see what Dirk already mentioned. These preference differences between what we would say, the hardliner financial managers. Still seeing preferences in social impact. Maybe they're better at seeing the business case of social impact. That's of course a very interesting question. I think we should also ask ourselves. But I doubt that they're gaming, improving. Okay. They're really worried with the social manager image in general.
No, that's a fair point. As you say, it's anonymous, so they wouldn't do that. That's interesting. And so, what would you say as sort of the key takeaway? This is an EPRA webinar with the members. What would be the key takeaway that you would say to the EPRA members from this? Because it's a new area, and this is definitely some of the more interesting research in this area that I've seen. What's the sort of key takeaway that you'd like people to have from this?
Yeah, so maybe that relates to one of the things we haven't shown today because of due of time, but also maybe to raise the appetite to read this paper indeed. So the second half of the paper is actually repeating the same thing, but then with a different question in mind. So the 123 basis points I discussed at the beginning are really not there when you ask people for something that is less clear than lowering rent in sake of affordability. Because I guess that's really, for me, really interesting at the end. So if I talk to investors and also to EPRA members, I say I'm very willing to do this, but indeed I have to have a very clear narrative to tell my stakeholders, including my shareholders. So if I can show them something that is very concrete, so with this deep retrofit that was really more about the health benefits of your tenants, well, that is there, but it's less evident, let's say, to have a metric on that. So if people say we have boost affordability by so much %, that's quite clear. People really appreciate that. But we deliberately included that question as well. And then you will see that, yeah, the basis points people are willing to sacrifice for that is a lot less, which I also completely understand. So that's really the message also. If you want to involve people in this, you need to also be very clear on what can you give them as something in return, and is it something that they really can explain to other people? Yeah,
I think that's a fabulous point, because I think if you think about it, I guess one of the reasons for doing this is the availability of capital. Yeah. So if you're trying to get capital from equity or debt providers, particularly some of the larger providers of capital, you absolutely will have to show, and this is told to me a while ago, but by some of the Dutch pension funds, but you actually have to have a sustainable business model. Forget the sustainability per se, but sustainable business model.
Yeah.
And actually having affordable rents as part of the portfolio means that effectively there's potentially long-term growth rather than actually a long-term decline. So I think your point's absolutely well made, Dirk, that if you can show something that sort of combines, to me that combines financial prudence with social impact,
Yeah.
and you can actually have, and it might be the case in that case, you're just foregoing short-term gain for longer-term gain, because it's affordable in the longer term, you might actually catch up. But I think that's a great way to end this half an hour in terms of members, that it has to be very clearly prioritised and sort of spelt out, and that it has a very material impact on the pricing effectively, whether it's something that people can see and identify with, or whether it's something that effectively you are just giving up and it's much more philanthropic.
Indeed,
in a sense. It's not tied in to Brilliant. Well, one question before we do go, though, because I don't want to let you go, even though we're sort of running out of time. It's just, how do you see, we've obviously seen what's been going on, particularly the other side of the Atlantic, and certainly in certain areas within Europe, there's been a rowing back in terms of ESG commitments in broad terms and sustainability commitments. How do you see, open-ended question, how do you see this particular area evolving, both sort of short term in terms of the pressures from people, and also how it develops, and how, because I think companies are only just starting to get to grips with what social impact really means for them, because it might be different for different sectors of the real estate market. It certainly will be, and certainly different for real estate compared to other sectors. So how do you sort of see it evolving, and where do you think we are now, given the last sort of few months from across the Atlantic?
Yeah, so I think what I do observe is that companies and corporates are now also ending the era that social is really a matter for governments, and that they need to take care of it. And I also think it's a quite nice development. It's also like you phrased yourself, Alex, just now. So I think if you are maybe squeezing, let's say, the tenants for a last bit of a rent, it's not a long-term play you can really succeed in, because it will eat in your vacancy rates, also the appreciation. So having happy tenants is really important, and it's not normal in 2025, unfortunately, because in the housing market, there's a lot of social pressure also for a lot of generations to get into the housing market affordable. So I think we do also see this tendency that, apart from the fact that some people doubt the underlying story causality of, for instance, these climate change facts, well, for social, that's something that really affects the people around you. And I think you see more and more examples of real estate companies and investments that say, well, we have an impact. We are the biggest assets in the lives of people, and we also would like to make a positive benefit there. So I do think there will be a group that, despite, let's say, the political, let's say, tenure, there will still be this ambition to make the world nice for everyone. But that's not always the case, of course, and that all never has been in the past, but I don't see this evaporating soon.
Excellent. Well, listen, thank you so much. And I would encourage everybody who's here and who watches this also on a recording to both download the report, and if you haven't taken part already, please take part in the survey, because obviously the greater the number of data points, the greater the validity of the findings. But that was a fabulous session. Thank you very much indeed for that, gentlemen. And look forward to seeing EPRA and your members next time. Thank you very much.
Bye-bye.
Thank you.